Now, the question is, do we want to invest? Well, going through the checklist here of this entertainment venues company, PE of 9, we like that, give that a check. Earnings per share CAGR negative, that's definitely an X on the list. Debt to equity of 1.35, we can give that a check, that's not overwhelming. Gross margin 63%, operating margin 10%, and net profit margin of 5.8%. We can give those all checks, decent for sure. Return on equity of 13.5%. We definitely like it above 10%. That is a good sign. Give it a check. Revenue growth, net profit growth, shareholder equity, and free cash flow growth. It's mediocre. I don't think I'm going to give it a check. It's nothing crazy, not overly concerning, and we're seeing positive signs for the most part, but it's not great. The biggest question or biggest risk I see with this business is their debt to free cash flow ratio. Again, we want to see it at 3 or below, and right now we're seeing 7.5. So there is some concern that they have more debt than the cash that they're bringing in, and it's going to take more time to actually pay off that debt in order to become debt free. There's still potential that because of this high debt and the concern, obviously there was some form of catalyst that really led to this crash over the more recent period. I don't know if it makes sense to make a massive investment. In this case, we're going to set it at about $1 million and we'll see how it plays out. And down, what another massive swing. You know, these stocks are crazy sometimes. It's crazy to see how over a 5-year period, how a stock can change from left to right and what goes on in between. This is an interesting one. There was definitely a catalyst, and if you recall, most public venues were being shut down due to the COVID-19 pandemic, and that's definitely a near-term hit. That's a risk that these businesses have to take, and if you're not in a sustainable position where you weren't profitable in the past, or you don't have a lot of cash, or you have too much debt, you can definitely run into trouble. But in this case, Cinemark, it stayed profitable throughout that whole entire period, and it was able to at least brave the near-term threats. The question is, would it survive after the case? Well, it definitely did, and you can see that if you had invested in this business, you would have generated about 110% returns from that moment in time. That's a 13.5% CAGR, and in this case, we just added another $1 million to our portfolio.